Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Jeremy Schwartz, Global Chief Investment Officer at Wisdom Tree Asset Management, and we are talking about investing in Japan today. Wisdom Tree offers some excellent Japan ETFs that have done quite well this year. So Jeremy is, of course, the perfect guest to talk about this topic. Jeremy, welcome back. Great to have you with us today.
You know, you got me on one of my favorite topics, so thank you for
Excellent.
having me.
Excellent. So Japanese stocks surged last month after Sane Takaichi. She became Japan's first female prime minister. So let's start with her agenda, her policy. So what should our listeners know about her policies, what many are now calling Abenomics 2.0? And why do they seem so supportive of Japanese equities?
Yeah, I'd say she has been. That's exactly the phrase I would use. Is she's being marketed as Abe 2.0. She's very friendly with the Abe policies, and I think she and in a way for the U.S. like Abe was very close friends with President Trump, and you could say Japan's last prime minister was having some issues with President Trump. They were sort of set to be a very good ally of the U.S. and one of our strongest allies in Asia, along with India. I mean, Japan and India are some of my two favorite long-term countries, but there was some conflict there, and with all the tariff negotiations and the rest. But we think Takaichi is going to help get that relationship solidified again. But for her own market, there's definitely a sense of they've got inflation going on. There's some insecurity there, but she's coming back with a strong agenda. She has a bunch of ambitious policies, but also trying to solidify defense. I mean, that's one of the other key themes of 2025 with the European story and the conflict with Russia, Ukraine, and all the defense spending coming out of Europe. She wants to bring up a lot more spending on defense. And you see that even recently, just the last few weeks, some tension with China on her statements for Taiwan. But that's a big theme, like the defense of Asia and how to spend on that. And we could talk about the long-term cycle on that, but I think that is catalyzed a lot of innovation. And so it's just a pro-market sentiment, I think, coming with Takaichi in as prime minister.
Great. So let's talk a little bit about the currency as well, because I think a couple weeks back or last week, the yen dropped to a 9-month low, and that was after Takaichi's first face-to-face meeting with the BOJ governor. And she has signaled a preference for looser monetary policy. And so, of course, there's speculation that she may pressure the BOJ to delay rate hikes. And Japanese stock markets, they love a weaker yen, right? Because it boosts exports. So how do you think her policy may impact the currency from here?
Yeah, it's fascinating. Coming back to Abe, if we say Takaichi's Abe 2.0, when Abe came in, he had a very strong yen. So, I mean, the yen was 75 to 80 yen to the dollar. We're almost half of that now at 155, 156 as we're talking, a little bit higher. So it's a very different dynamic. Back then, the yen was way too expensive. And there's some sense of it's not, overly expensive that like it was. So I wouldn't say we're going to have a dramatic weakening like we did with Abe 1.0. And some of the strategists I follow would actually like her to try to strengthen the currency to offset the inflation dynamics. But as you said, that's like a very tricky dynamic for the markets, which, the profits tend to go up with the weak yen. So there's this balance there. And what's interesting is how interest rates have been rising. I mean, so part of what got a very weak yen is just the relative interest rate differential between, say, the global markets, the U.S. and Japan, and some of those spreads have come down, but their 30-year bond well above 3% now. I mean, it was like at zero for so long. It's so that yield has moved higher, and the currency still has generally been weak. So it's sort of a kind of interesting dynamic. This comes back to one of my key topics for the last 12, 13 years, I've been saying people take too much currency risk when they go overseas, that it's uncompensated risk. Who knows what they do? It could surprise people a lot. And, you're still paid today 3% plus to hedge the yen because of where the Fed is and where the Bank of Japan is. And maybe that 3% plus that you're paid today shrinks to 2% at some point, but you're still paid to hedge the risk. And so the carry trade, as you might call it, is shrinking, but it's still, you're paid to take a risk off the table. And I think that's when Mr. Buffett, who's one of my big who I admire a lot of his thinking in terms of what he's done as a long-term investor. He's been buying 5 Japanese stocks that he says he wants to hold for decades. But when he bought it, he hedged his currency because he had no idea what the yen was going to do. And he was, issuing debt to offset that. So I think most people should follow the Buffett lead. What I've been saying, don't bet on the yen, buy the stocks. They're cheap. Currencies will move around. And for sure, if she's successful in keeping the Bank of Japan looser for longer, that could be a yen weakening thing. But it's also what the Fed does and all these other things. But a lot of things surprise people. And so I would just say focus on the stocks and not the currency.
I agree with you. Currency hedging makes a lot of sense, particularly when investing in Japan. Now, going back to the stock market rally, we should remember that Japan's stock market was actually doing quite well even before this election. So what are some of the other factors that have been driving the broader Japanese equity rally this year?
It has been a move for international. Now, I think a lot of the move in, say, Europe, let's say, was partly currency. The dollar had been weakening for a while, not versus the yen any longer, but there was this sort of rotation back to Europe with all and I do think the defense spending was a key catalyst for the rotation in Europe and somewhat of a weaker dollar to start the year. Japan is really being fueled by good dividend growth, good earnings growth, good fundamentals in that sense. So, just strong underlying earnings. Now, they've also had, AI is the key story around the world. They have some leading AI companies. When you look at the Nikkei, now it's had more volatility in the last few weeks, but SoftBank is a prime example, was driving higher. Tokyo Electron. They've got a lot of companies that you might not, be as familiar with the Magnificent Seven in the US, but they do have some good technology, good semiconductors, good parts of the whole industrial base that are feeding the key stories around the world. So that's also been one of the things powering Japan higher.
So you alluded to Takaichi's remark that led to some tensions with China. So in fact, we have seen some sell-off in tourism-related stocks amid these rising tensions with China. And China, in fact, issued a travel warning to its citizens after she remarked that Japan's military could intervene if China attacks Taiwan. And you also mentioned 30-year JGB yields rising. So long-dated JGBs have sold off. That's mainly on worries that a huge economic stimulus package could worsen their fiscal health. So I'm curious to hear your take on these recent pullbacks.
Yeah, I think I describe Japan as like the anti-bubble in many ways. Like that's one of my favorite ways of calling it. Like we have a few different ways of owning Japan, but one of my favorites now has a 12.5 PE when the S&P is like 24 to 24 PE forward. So half the multiple with companies returning more cash to shareholders. The fiscal side, if they're going to spend more, that's good for the local economy. They've been one of the more experimenters with, the central bank buying the bonds. And now for a while, it kept the bond yield so low. They're rising a little bit, but that's not so unhealthy for their banking system. And, they've managed through it. For a while, it didn't have any implication for the currencies, but, they've got some of the highest debt to GDP around. And that's, a big question around the world is the debt and deficits. And they're at the forefront of how central banks interact with bonds and with a very aging population with their demographic profile. But she's taking a hard line on some of these things. But that if you come back to the defense spending, I think they should spend on defense. And I also think that it leads to this longer term, what we call a defense tech super cycle. So I between what Europe's doing on their spend to as a result of the Russia-Ukraine war, and this is not like a 1-year spending commitment. This is like spending commitment for the next decade. I think Takaichi is going to change how Japan looks at it, and you'll get this defense tech super cycle that leads to strong innovation in new technologies. When you go back to the U.S., some of our great inventions came from DARPA spending, the space race, with the Sputnik moment in 1958, all led to things like the internet. And the walkie-talkies that we were using in World War II led to your cell phone. And so your spending on defense leads to a lot of great innovation. And so we might see Japan, we might see Europe lead more tech as a result of this spending than they did. So I'm not concerned about their debt. I'm not concerned if they're spending on defense. All these things will lead to positive feedback loops that will be long-term supportive.
Makes sense. Let's talk a little bit about valuations. And you mentioned valuations relative to the US, but we know that lately there has been some concern about stretched valuations, and both in the US and Japan, and that too particularly in the AI and these chip names. But in Japan, those sectors make up a much smaller share of the major indexes. So tell us about valuations. Do broader Japanese stock market valuations still look attractive relative to their own historical levels?
Yeah, so the way I look at it, we've got the S&P 23.8 times forward earnings. I'm showing sort of as of the end of October, MSCI Japan right around 18 times forward, broad international benchmark 16 times. When the way Wisdom Tree looks at it, one of my flagships, DXJ, is 14.7. Our Japan Opportunities Fund, a newer fund, is under 13 times. So, just like any market, there's ways you can find cheaper segments of the market. So below 13 times is like the cheapest Japan's been in 30 years. So it is like, it's as low as I've seen it since I've been at Wisdom Tree for the last 20 years. So it is definitely the gains. I mean, this is one of the exciting things about the Japan Opportunity and in our specific fund, the Japan Opportunities Fund, is not being like the US and the tech stocks are driven by earnings growth, but also by huge moves in valuations higher. Japan has been driven by fundamentals. Like the earnings have been growing to support this. Dividends have been growing. The cash flow yields have been supporting buybacks. So it's really not, in my view, there's segments of the market that are not cheap. I mean, that are not expensive based on their own history. And so it does feel more driven by the fundamental picture.
Please tell us more about these Japan ETFs. You mentioned DXJ, and in full disclosure, I own it in the ETF investor portfolio that I manage. And you also mentioned the Opportunities Fund. Tell us more about these funds.
Yeah, it's always, Nina, always tough to pick between your children when you've, been part of creating. What's your favorite child for Japan? DXJ or this new Japan Opportunities? My own, how I've been allocating Japan, and it's been, one of the few places that have beaten the S&P 500. When you look internationally for the last decade plus, like when Abe came in 2012, very few things have been able to keep up with the S&P, but DXJ has been able to beat the S&P actually since Abe first came in 2012. Broad unhedged Japan has only done something like between 6 to 7% return, 6.5%, almost exactly for that year, when the S&P did 14. So it's been a huge doubling of the annual return, and the compound return is even more dramatic because it's well over a decade of that kind of outperformance. Now, when I looked at it, we had launched some back in when currency hedging was much more popular when Abe came in 2012 to 2015. We launched a bunch of different funds. We had a small cap fund, both hedged and unhedged. And I looked at what was happening around the world. I looked at what Buffett was doing to inspire confidence back into Japan. And I was getting some requests for more direct exposure to those 5 particular trading companies that he's been buying. So we said, how about we broaden the exposure and the aperture from just small caps to help get something in the Buffett-like experience. So OPPJ, which is that Japan Opportunities Fund, has, today roughly a little bit less than half of the portfolio in the 5 Buffett stocks. So 40 to 45% will be our target exposure to the Buffett stocks. And then we're trying to find stocks that Buffett might like. Like, what are the types of stocks that he likes? He likes high shareholder yield companies doing good dividends, good buybacks, selling at cheap valuations, but good underlying, long-term earnings trends. And so we have 2 systematic, I'd say, value exposures focused on shareholder returns, dividends and buybacks, and earnings growth. And then we have a sort of flexible budget in looking for things, relevant to the geopolitical evolving landscape, things like the defense-oriented names and other things tied to the macro environment. But it ends up being a little bit over 100 stocks, 120 positions, but with, again, 13 PEs and very good buybacks. And so I think that to me has become, one of my preferred vehicles. We can be flexible on the currency. Today it's fully hedged, but if it approaches levels that we think have gone too far on yen weakness, we'll have the ability to adaptively put some currency exposure back in. So it'll take a bit more active approach on the currency side. But and DXJ is a flagship. It's our biggest fund, a little bit under $5 billion. And just is broad global companies, and hedges the currency with that additional kicker as well.
Very interesting. Now, we talked about a lot of positive factors. Are there certain risks that investors should be aware of?
Well, I think you hit on it, and that the currency is definitely a key part of the story. Is when Japan's had the volatility. If you think back a few years ago. There was speculation actually was Buffett selling his stocks during one of the flash crashes in I think it was during one of the August periods back not quite 2 years ago. But it's the currency volatility can lead to this risk on, risk off sentiment, and you sort of had like this flash crash in Japan where the currency was spiking, led to this big sell-off, and was there these unwinding of carry trades that people said people were borrowing in yen and buying all these things that led to a risk-off sentiment. Right as that was happening, we were saying, hey, you should be buying this sell-off, and in our own model portfolios, we added to Japan on the Monday after the big crash, which turned out to be a very, very good time to buy. But so that extra volatility, you've got to be careful not to panic at those low points because of that volatility unwind. You see, are you seeing it in the crypto markets now where you get all these liquidations because of leverage? And so, the yen carry trade has some of that, you could say, leverage dynamics. Now, our funds are using it in terms of just hedging the risk. They're removing the currency risk, but it adds this extra interest rate differential. It adds that extra return. And so that 2 to 3% of interest income we earn on top of the local market returns. Whatever the Nikkei was doing, let's say, you're adding 2 to 3% on top of the Nikkei just by being neutral to yen. And so I think that's still a very positive dynamic, but that does, in those risk-off moments, can be a risk. That's the biggest, wild card risk. And you'd say, if there's any big flare-up in tensions in China, China is a big part of their, they export all over the world. They're definitely tied to global growth stories. So if China and Japan goes very, very negatively, that's certainly a risk. And that geopolitical risk is very top of mind. I think the U.S. relationship with China is one of the big wild cards still, and we're still negotiating trade deals. But I do think in the next 6 months, that relationship with China will become front and center. And so that's the key thing to watch in the short run.
Great stuff, Jeremy, as always. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
We appreciate you talking our favorite topic, Japan. Thanks, Nina.
Thank you. That was Jeremy Schwartz of Wisdom Tree. Let's recap the ETF tickers. So he talked about the Wisdom Tree Japan hedged ETF. The ticker symbol is DXJ. This holds dividend-paying Japanese exporters and hedges out the currency risk. as the name suggests. And he also talked about the Japan Opportunities Fund, ticker symbol OPPJ, OPPJ. And this is for investing like Buffett in Japan, and about 45% of this ETF's weight is in the Buffett basket, which comprises his original investment in the 5 Japanese trading houses. Now, the most popular product for Japan is by iShares. The ticker symbol is EWJ. This is unhedged and has underperformed the hedged ETFs. And Franklin offers a couple of Japan ETFs which are cheapest in the space. FLJP is the unhedged fund, and FLJH is the currency hedged fund. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.